The cornerstone of M&A, mergers and acquisitions represent a significant strategic avenue for companies to expand, diversify, or streamline their operations. At the heart of every M&A deal lies a fundamental question: what is the target company worth? Determining a company's fair and accurate value is paramount. The valuation process involves a comprehensive assessment of the target company's financial health, market position, growth prospects, and risk profile. By employing various valuation techniques, acquirers aim to establish a realistic purchase price that aligns with the target's intrinsic value. A well-executed valuation provides acquirers with the confidence to pursue deals that enhance shareholder value and avoid those that could erode it. Overpaying for a target company can lead to significant financial strain, while undervaluing it may offend the seller and jeopardize the deal. A well-founded valuation, therefore, acts as a safeguard, ensuring that M&A decisions are grounded in sound financial analysis and strategic rationale. The discounted cash flow method stands as a cornerstone of company valuation, particularly in M&A scenarios. This method operates on the principle that the value of a business stems from its ability to generate cash flow in the future. By projecting these future cash flows and discounting them back to their present value, using a discount rate that reflects the time value of money and the risk associated with the business, the DCF model provides an estimate of the company's intrinsic value. The DCF analysis typically involves several key steps. First, historical financial data, industry trends, and macroeconomic factors are analyzed to forecast the company's future revenues, expenses, and capital expenditures. These projections form the basis for estimating the company's free cash flow, which represents the cash generated by the business that is available to be distributed to its capital providers. The discount rate is crucial in bringing the future cash flows back to their present value, as it accounts for the fact that a dollar received today is worth more than a dollar received in the future. Subtracting any outstanding debt and adding back cash and cash equivalents yields the company's equity value, which can be divided by the number of outstanding shares to arrive at the intrinsic value per share. Comparable company analysis offers another widely used valuation technique in M&A, drawing upon the principle that companies operating in the same industry, or possessing similar characteristics, should trade at comparable valuations. This method involves identifying a set of publicly traded companies that share key attributes with the target company, such as industry, size, growth rate, and profitability. Once the peer group is established, various valuation multiples are calculated for each comparable company. These multiples, such as price to earnings, price to sales, and enterprise value to EBITDA, provide a standardized way to compare the market values of different companies relative to their financial performance. By applying these multiples to the target company's corresponding financial metrics, such as its earnings, sales, or EBITDA, analysts can derive an estimated valuation range. Factors that may warrant adjustments include the target's specific growth prospects, risk profile, management quality, and competitive positioning. Precedent transaction analysis provides valuable insights into M&A valuations by examining the prices paid for comparable companies in past transactions. This method assumes that the historical prices paid for similar businesses can serve as a reference point for valuing a current target company. The process begins by identifying past M&A deals involving companies that share key characteristics with the target company. These characteristics may include industry, size, financial performance, and strategic rationale for the acquisition. Once a set of precedent transactions is compiled, various transaction multiples are calculated using the same principles as in comparable company analysis. By applying these multiples to the target company's corresponding financial metrics, analysts can estimate a potential transaction value. Past transactions may not always reflect current market conditions, industry dynamics, or company-specific factors. Additionally, the availability of comprehensive data on past deals, including the specific terms and conditions, can sometimes be limited, potentially impacting the accuracy of the analysis. Section 5. Asset-based valuation, when the sum of parts matters. Asset-based valuation takes a different approach to valuing a company, focusing on its underlying assets rather than its future earnings potential. This method is particularly relevant when a company has significant tangible assets, such as real estate, equipment, or inventory, and its future earnings are uncertain or difficult to predict. The process involves identifying and valuing all of the company's assets, including its current assets, fixed assets, and intangible assets. Current assets such as cash, accounts receivable, and inventory are typically valued at their net realizable value. Fixed assets such as property, plant, and equipment are often valued at their net book value, which is the original cost of the asset less accumulated depreciation. Intangible assets such as brand names, patents, and customer relationships can be more challenging to value, as they lack a physical form. Once all assets are valued, the company's liabilities are subtracted to arrive at its net asset value, or NAV. Section 6, Tesla, a valuation journey through DCF and market comps. Let's embark on a valuation journey using Tesla, the electric vehicle and clean energy company, as our case study. We'll explore how to value Tesla using two prominent methods: discounted cash flow or DCF and market comps. DCF analysis. First, projecting future cash flows. Tesla's future cash flows will depend on factors like vehicle sales growth, average selling prices, manufacturing costs, and investments in research and development. Analysts would project these variables over a long-term horizon, considering industry trends, the competitive landscape, and Tesla's own strategic plans. Next, determining the discount rate. Tesla operates in a rapidly evolving industry with inherent risks. The discount rate reflecting the company's risk profile would be higher than that of a stable, mature business. Finally, calculating present value. By discounting the projected free cash flows back to their present value using the chosen discount rate, and adding the present value of Tesla's terminal value, we arrive at an estimate of the company's intrinsic value. Market comps analysis. By applying the chosen multiples to Tesla's corresponding financial metrics, such as earnings, sales, or EBITDA, we can derive an estimated valuation range for the company based on the market values of its peers. Section 7. Choosing the right valuation tool, a matter of context. Selecting the most appropriate valuation technique depends on the specific characteristics of the target company, the industry in which it operates, and the overall M&A landscape. Each method has its strengths and weaknesses, and the chosen approach should be tailored to the circumstances at hand. DCF analysis, while considered a robust valuation method, relies heavily on projections of future cash flows, which can be inherently uncertain. Comparable company analysis provides a market-based perspective on valuation, but it assumes that the market is efficiently pricing comparable companies. Precedent transaction analysis offers valuable insights into historical premiums paid for similar businesses, but it may not always reflect current market conditions or company-specific factors. Asset-based valuation provides a floor value for a company based on its underlying assets, but it may not fully capture the company's future earnings potential or intangible value. This method is most relevant for companies with significant tangible assets or those facing financial distress. Section 8. Beyond valuation, the road ahead in M&A. While determining a company's value is crucial in M&A, it is not the only factor driving deal success. Once a preliminary valuation is established, the M&A process progresses to the due diligence phase, where the acquirer conducts a thorough investigation of the target company's financials, operations, legal compliance, and other relevant aspects. Due diligence aims to validate the assumptions made during the valuation process, uncover any potential risks or liabilities associated with the target company, and confirm the strategic rationale for the acquisition. This phase involves a multidisciplinary team of experts, including financial analysts, accountants, lawyers, and industry specialists, who meticulously scrutinize the target company's records and operations. By conducting thorough due diligence and comprehensive risk assessment, acquirers can gain a deeper understanding of the target company, mitigate potential deal risks, and negotiate more favorable terms. These subsequent steps are essential in ensuring that the M&A transaction aligns with the acquirer's strategic objectives and creates sustainable value for its stakeholders. Section 9. Conclusion. Mastering M&A. A continuous exploration. Mastering the art of M&A valuation requires a deep understanding of various valuation techniques, the ability to adapt these methods to different industries and company profiles, and the judgment to interpret the results in the context of the overall M&A landscape. It's not a one-size-fits-all approach, but rather a continuous exploration of value drivers, risk factors, and strategic considerations. As companies navigate the complexities of M&A, a robust valuation serves as a compass, guiding them towards deals that enhance shareholder value and avoid costly mistakes. By embracing a disciplined and comprehensive approach to valuation, acquirers can unlock growth opportunities, diversify their portfolios, and navigate the ever-evolving business landscape with confidence.